welcome to the Money Show, the retirement special. I'm Avan Divash. Every once in a while, we like to touch upon specific and special topics. And today, we thought we'd talk a little bit more about retirement. When is the right time to start saving? What is the outlook on, the right way to go about saving and investing for your retirement? And to join us on the show and dispel a lot of thoughts and doubts about that is PV Subramanyam, CEO, Subramanyam.com. Love to have you in the studio. Thanks so much for taking time out and joining in. Now, there's so much to chat about, but let's start at the beginning. You started off by saying that retirement is a sum of money, not an age. Can you just elaborate a little bit more as to what is the right time and the important stages as well for retirement saving?
Yeah, see, at what time you retire is a function of what profession you are in. Like a gymnast retires at 16 or 17, at the age when others have not even thought of what career to take. A tennis player would retire maybe at 32, 33. A film star would retire maybe at 33, 34, 35, 40, whatever. And a normal person taking up a job would retire maybe at 55 or 60. So, but you need not work till 60 if you know how much you require for retirement and that amount is ready for you. Like if it's ready for you at 52, you don't need to work beyond that. The only challenge is you don't know how long you will live, and if you could live till 110, a person who is about 30 years now should be ready to live till 110. So you're talking of about 40, 50 years in retirement from 60 to 110. You need to know how to manage your money during that period. That is the challenge.
And you've also spoken a little bit about how active earning is still lagging, versus one's lifespan.
Yeah, I mean, if you take a typical job today, I don't think you're going to work beyond 55. I mean, and it's a young country. So somebody is going to push and say, look, younger people need to be given a chance. So let this old man at 50 go. So 50 is going to look old, and then you're going to live till 110, which means you have to make. People find it difficult to make their paycheck last 30 days. Here we are talking of a sum of money to last 60 years. No generation has done this. Even when you started the show, you said saving for retirement. Saving for retirement is gone. Now it has to be investing for retirement. You cannot save for retirement at 8% where inflation is 9%. You just will never be able to save enough. You need to be investing so that you get a real return and you create a corpus.
Okay, our phone lines are already going quite crazy right now. So let's get in some viewer queries, email queries, and even video queries. Our first question is from Shalini Midhani. Let's take a look at her question.
Shalini Vidhani here, and I've been in stock market for almost 22 years now. The field that I have chosen, there is no retirement as such. So I'm going to be working. I would rather like to be working till I'm there, till I'm alive. Don't want to give up on that at all. As for aspirations, I love to travel. I want to fulfill all those. Then my sons, they are looking forward to a destination wedding as the trend is these days. So all those expenses I need to compensate from this market. So that's what I'm looking forward to. The investment that I'm doing in the stock market as well as in the mutual fund, it's giving me a steady income to go in for the holidays as well as for the destination weddings or any other future education plans. I have a steady growth of funds going on in the mutual funds. So that's helping me a lot. It gives me a lot of relaxation to know that I have a chunk of fund standing behind me to cover all the expenses.
But is it enough? Gonna take it straight to you. How would you look at her financial planning so far? She has a lot of specific goals in mind. Is it enough?
Yeah, see, the question is, we'll never know whether it's enough because she's not spoken the numbers. She's just said broadly. Now, let us put it this way. She is maybe about 50 years of age. She's got son's wedding to talk about, so maybe she's about 50 years of age. So a thumb rule is, if her expenses at her age of 60 is about 10 lakhs, then she needs 10 lakhs into 35, that's the number, so because she could live for another 30 years. The other challenge is, by the time she's 70, she will have to remember that her faculties may not be very sharp and equity trading may not be a great thing to do beyond the age of 70. In fact, Ken Fisher talks about it, that his father, who was a very good investor, was not a good investor beyond the age of 70. So at 70, she may have to go for simpler investments like fixed deposits and annuities, and those are not very efficient. So she will need to have a big corpus at that age, and I think she's got to get her priorities right. She has to first know how much she requires for retirement, put it into a box, and then spend on destination weddings. Destination weddings are nice and it will happen now, but a retirement will happen over the next 30-40 years. So she has to remember, in terms of priorities, the retirement box is more important than the destination wedding, but in terms of timing, the destination wedding will happen first and the retirement will happen later.
All right, that's the question coming in, and I hope we were able to help you out. Next up, I believe we have Gokul Das, who is with us on the phone line, I think. Welcome to the show. You sent us your email question as well. Go ahead with your query.
Yeah, madam, good evening.
Good evening.
Since last 8 years, I am investing in mutual funds. My present fund position is like this. SBI Magnum Medium Duration 5 lakhs, SBI Blue Chip 5 lakhs, HDFC Top 100 1.5 lakhs, HDFC Mid Corporate Opportunities 2 lakhs, HDFC Hybrid 4.5 lakhs, Kotak Standard Multicap 8 lakhs, ICICI Balance Advantage 3 lakhs, L&T India Value 1 lakh.
Okay.
I have investment in bank FTs around 22 lakhs.
Okay.
I am just retired now.
Okay.
So in weeks I am receiving terminal benefits of 30 lakhs.
Right.
I want you to advise me whether my portfolio is okay and how to invest these 30 lakhs.
Okay, sure thing. We'll be doing just that. So how would you look at his entire portfolio, and which are the funds that you need? Do you think he needs to tweak, because he has quite a number of them, but he wants to spend on his daughter's marriage and have the sum last, as you said, for a long period of time?
Yeah, see, I'm assuming that your pension will be enough for you and your wife for the rest of your life, and you will not touch this corpus for anything else other than your daughter's, your son's wedding, or to match inflation. So I would suggest that you get out of HDFC Hybrid, HDFC Top 100, and maybe out of ICICI Balance Fund also. Take that money and put it into Mirai Blue Chip or Mirai Emerging Blue Chip Fund, and maybe just do a lump sum. Please remember, this is not enough for you. You have something like 80 lakhs, you have something like 80 lakhs in all your investments, and this has to last you next 35-40 years. So if the pension is not sufficient, or if the medical cover that you have does not cover certain things, I don't know. I mean, how are you going to take 30 lakhs out of this for your daughter's wedding or your son's wedding? And you also said you want to take vacations in this. I think the corpus is not enough for you to take foreign vacations every year. This corpus may not be sufficient, but I don't know your pension. You have not mentioned your pension figure. So if that pension figure allows you to take your vacations, great, but this corpus I wouldn't touch for the vacations.
Yeah, I don't think we have that pension figure. We have the bank deposits as well, but yeah, foreign travel, daughter's marriage, etc. Some tweaks have been made into your entire portfolio. Start an STP, 50,000 rupees per month as well in Aditya Birla Equity Hybrid Fund. I hope we answered your question. Well, next up, let's take a look at Ketan Adya, who's 50 years old, and he has a problem that I'm sure a lot of people watching do. Savings only in fixed deposits. Let's hear him out.
My name is Ketan Adya, and I'm from the media industry. I'm an editor and I'm also a producer. My idea of good retirement is actually, I had planned to retire at the age of 50 or something, I wanted to earn enough money, and I wanted to travel. I had planned to have a relaxed life, but it has not happened. I have already crossed 50. Now my target is 60. So I'm hoping to retire by 60, and after retirement I just want to live a relaxed life. I want to enjoy my evening drink with some music, some television, and occasionally travel. I have not planned much because we in creative field, we are not that money minded or that. We are more into this filmmaking, and also there are no plans as such except for making money and saving and all that, and maximum what we think about is FDs and all. But further, we don't have that idea and all that.
Well, his creative mind has not allowed him to be creative when it comes to investing and saving, but I'm sure you'll agree that it's high time that he starts.
I mean, I would be very scared if I were him.
Yeah.
Let's put it this way, assuming his household expenses are about 1 lakh per month, and that is about 12 lakhs a year, he needs to live and needs to know how to live for the next 30 years. So 12 lakhs a year into 30 is 3.6 crores, and I don't see him having created 3.6 crores because this 3.6 crores could have happened with a 1 crore of investment growing to 3.6. See, you know, when you create 3.6, it's not as though you have tried to save 3.6, you have tried to invest about 50, 60 lakhs or 70 lakhs, which has grown to 3.6. Now, I don't see that happening. So maybe he will not retire at 60. He will work a little longer. He will perhaps spend less. He did not sound very expensive in terms of saying, I want to spend some time with music and television and a drink and maybe an occasional travel. That should not be a problem. But no, I don't think he's got. The problem with saving is saving does not give you a real return. If inflation is about 8-9% and you get 7% and on that you pay 30% tax, your money is not growing. Your money has to grow with equities. So at least at this stage, let him start an STP or an SIP with his income, at least for the next 10-15 years, and start withdrawing from that only at the age of 65 or 70. So let him do that. I don't think his retirement is happening even at 60. He's creative. Let him work till 70.
And he needs a financial planner immediately?
Absolutely. He should meet a financial planner to know how much risk he should take. You know, it's easy to go overboard and put all the money in equities and then wonder what happened. So he can't do that, and he can't say, I will not be in equities. So it's a very thin line for him to balance.
Okay, so still some time before you are able to just put your feet up and enjoy your evening drink. You can still do that while working and maybe while talking to your financial planner. Let's take a look at the story of Dr. Hemant Dugard as well, who's partially retired. He wants to know about saving for retirement and his daughter's marriage.
I'm Dr. Hemant Dugard. I am a gynecologist. I am practicing since last 33 years. I have my own hospital. I'm already semi-retired, and the majority of the advice what comes now is that whether you are in stocks or you are in mutual funds or you are into any investment, you have to give a period. I am at 60. Am I too late for all this? So now what next? Because I have my responsibility that one, my remaining life at the same standard what I am, and daughter's marriage. These are the two major things for which my planning revolves around. And what I have done is my major investment, or you can say savings, is into FD. Main thing is that can somebody think or plan at 60 for a very near goal?
All right, that's the view coming in, and a valid question, a doctor, but is it too late to start, right? And I'm sure a lot of people are in the same boat.
No, not for a doctor. See, a doctor actually starts earning only about 34, 35, and his income peak hits only at about 45, 50. So it's definitely not too late. And because he has his own hospital, he's going to work till he drops dead. So it's not that, you know, when he's 60, somebody's not going to ask him to just stop coming. So he is going to work beyond 60, maybe he'll be about 70, 75. And the fact that he has got all his money in fixed deposits kind of investment doesn't matter, because his main business itself is equity. When it's your own business, that is equity. You know, you're taking a risk in that, your property is appreciating, your hospital is growing, he can get newer doctors coming in, so they're all going to work and he's going to make money. I don't think it's too late. Yes, some money in equities is useful because he's still young. By a retirement standards, he's just 60, so he could live till the age of 100. So he's got another 40 years to go. So yes, he needs to invest better. He needs to put some money in mutual funds. Yes, he has to let it grow, but he's still earning. So I don't think a doctor needs to worry about retirement till about 75, unless of course something physically happens to him, you know. Other than that, I don't think it's too late. So he can still start doing investments in some good funds and start withdrawing at 75 if he wants to hang up his boots at all.
Okay, Mirai Emerging Blue Chip Fund is what Mr. Subramanyam is also advising. Our phone lines are going crazy, so let's start off with Gokulnath from Bengaluru. Hi there, sir. Welcome to the Money Show. What's your query?
I am 58 years.
58?
I am 58 years now.
Okay, yes.
I did business from 36 years.
Okay,
Now I want to, at 60 I want to retire.
right.
I have a rental income and I have a bonus. I have a rental income of 50,000.
Okay.
For me, it will for monthly expenditure will be around 20,000. Which plan should I do for my rest of my life after 60?
Okay, over to you.
See, your expenses are pretty low. It's 20,000 and your income is 50,000. That itself puts you in a very comfortable position, because rent will go up at least as much as inflation. So even if your expenses go up from 20 to 25, your rental income would have gone up from 50 to 60. So one, that way you're protected. But yes, you got 30,000 surplus every month for you to invest. Put something like 20,000 rupees into some kind of a debt fund, which could be a Franklin Templeton short-term bond fund, and 10,000 you put in the Mirai emerging blue chip fund, and let it grow. You're 58, so let it grow till about 65, 70. After that you can decide how to withdraw. But as long as your rental property is gainfully used, I mean, if there is the only risk for you is if at a time one tenant vacates and you can't get a new tenant for 2-3 months, you will have a problem. During that period you touch your money which is lying in the debt fund for your next 2-3 months expenses. Otherwise, I think you're fine with retirement, because your rental income will keep going up right till you're 90 or 100. Of course, you may have to replace that asset. That asset may be old and it may have replacement, but otherwise you're doing fine.
Okay, that's the advice coming in. I hope, Mr. Gokulnath, we answered your question. Time for a very quick break. We have a lot of callers online. Please be patient, or even send us your queries on the Money Show at etnow.tv. Welcome back to the Retirement Special on the Money Show with PV Subramanyam. We're answering all your questions. We have a lot of live callers, so I'm going to get straight to it. Mahesh Kumar is connecting with us from Thane. Good evening. What's your query, Mr. Kumar?
Yeah, good evening, Avan. I just wanted to know, now I'm at 54 and not having any job in hand as of now, and there is no pension. I have about a few lakhs in FD and about 45 lakhs in stocks and mutual fund, which is unorganized. I need to generate 50,000 per month from the mutual fund and debt funds, etc. So how can I do that?
Okay. So he has put his money, stocks and mutual fund. He is getting a steady income from there. FD, no pension. What should be his biggest concern, and how would you assess his savings?
Yeah, see, the biggest concern for you should be longevity. What happens if you live another 30 years or another 35 years? What happens? So you have to hit a nice balance. You need to have your money in 2-3 boxes. One box from where you can withdraw for your expenses, and one box which will grow. Right, so the equity money is something which you should not be touching for long periods of time. Please remember, last 3 years SIP returns are in single digits. Okay, you could be getting 4% and 5%. So you cannot touch equity funds now for your expenses. Your money for your expenses have to come from your fixed deposits or from your debt funds, low duration debt funds to slightly longer duration debt funds. That is where you will withdraw from. You will have to leave your equity as it is. Maybe in the next 1 year, 2 years, 3 years, when equity does well, you will be able to withdraw some money and put it into these boxes from where you can withdraw. The thumb rule is you need as many years expenses as you have left. So if you have, say, 64 years of age and you have another 30 years to go, and your annual expenses are, let's say, 4 lakhs. So you're talking of 4 lakhs into 30, you need something like about 1.5 crore for you to retire. Right now I heard only a figure of 45 lakhs, plus you said you have some fixed deposits. So you will have to live far more frugally. I don't know your expenses. So if you're either you cut down your expenses, but don't touch your equity funds now. Wait for your equity funds to grow higher. Right now withdraw from your fixed deposits, and if you're paying too much of tax, shift from fixed deposits to low duration fund and medium duration funds and start withdrawing from that. Please understand, duration funds also are tax free, are taxed at a lesser rate only after 3 years. So whatever expenses you have for the next 3 years, you should be indifferent whether it's in a debt fund or in a bank FD. The other money should be in equity funds and into slightly longer term debt funds.
Okay, let's move on. Biman Chatterjee is with us on the phone line. Welcome to the show. What's your query?
I am Biman Chatterjee from Kolkata.
Yes, hi.
I have just retired and close to 60 years. I have a retirement coffer of 1.5 crores.
Okay.
Plus, I have getting a pension of around 7,000. So,
I don't think we have you on the best lines. Can you hear me, Mr. Chatterjee? Oh gosh, we didn't get that entire query on board. We'll connect with our next caller, G. Mahendran, a retiree with us on the phone line who's also emailed us his question. Welcome to the show, Mr. Mahendran. Go ahead.
Hello.
Yes, sir. Mr. Mahendran, what is your question?
I am 53-year-old, retired. I have made some investment in mutual funds, say about nearly 22.5 lakhs in the mutual fund. I have given the list also. So I want to get regular income from by way of SWP from the year 2022. Is it possible whether I have to change my mutual fund or rebalance it for the every month the stability of 23,000?
Okay, Mr. Mahendran, since you've also emailed us, I'm just going to, because of lack of time, I'll run Mr. Subramanyam through your funds. It's Kotak Standard Multicap, Mire Asset India, Mire Asset Emerging, ABSL Frontline Equity, SBI Blue Chip, Axis Dynamic, ICICI Pru Balanced, ICICI Pru Equity and Debt, and HDSC Hybrid Equity Fund. What's your advice?
Yeah, your portfolio looks good, but for withdrawing, I would want you to remove money from a few of these funds, maybe a little bit from each of these funds. All these funds look good, you know, none of these funds look too bad, and put money into a fund like a Franklin Templeton short-term duration fund or a Franklin Templeton short-term fund, ultra short or a short-term fund. Put into both of this, start withdrawing only from that. You will not be able to withdraw from equity funds, especially when the markets are not doing well. So you should have your withdrawals coming only from your debt funds and let your equity funds grow. So put this take a little bit from all these funds and put into a debt fund and start withdrawing from a debt fund. Please remember, debt funds are also taxable at a lesser rate only after 3 years. So till that time you could be in a fixed deposit or you could be in a debt fund. Withdraw from that, let this grow and keep replenishing that box from your equity funds. Don't withdraw regularly from equity funds, especially during a downside. The SWP will not work, so wait. Put into a debt fund and withdraw from there.
I think that's the advice that Mr. Subramanyam is stressing on as well. For your daily expenses, equity funds are not to be touched right now. We'll take our last question. It's a long one from Girish Vyas. He's due to retire in the next 2 years. He said, I changed my job. I've accumulated 15 lakhs in a non-operative account. I wanted to withdraw the same, but I had the following question. Should I close the PF account, which is dormant, earning 8.5%, and invest the proceeds in mutual funds instead? Is it advisable to put a lump sum in mutual funds? And which funds can I look at? So 3 questions. Should he shut the account? Should he invest in a lump sum? Which funds can he look at?
8.5% tax-free is good money. Don't let it go, because you will not be able to get 8.5% after tax from any debt fund. You have not said how much is the total corpus that you have. You have spoken about this 15 lakhs. If you want it to remain in debt, you are better off keeping it there. At least they let you keep it for about 3-4 months after you retire. Please remember, after that, if you don't withdraw, that amount becomes taxable. So you will have to withdraw after you retire. Since you've got 2 years to go, don't bother about it now. Withdraw it later. After you withdraw, you may be able to put 15 lakhs into some large cap funds, which could even be an ETF, could be Mirai. Yeah, could be, you could even put into a Mirai emerging blue chip fund. You could put into Franklin India blue chip. You could put it into Prima Plus, Franklin India Prima Plus. These 2-3 funds and let it grow there. Don't touch don't touch this money for 5-6 years and then put it into a debt fund and start withdrawing on a regular basis from the debt fund. Regular expenses, please withdraw from a debt fund. Don't withdraw from an equity fund. Equity fund, use it for growth. Debt fund, use it for expenses.
All right, that's the view coming in. Thank you so much for taking time out and, imparting a lot of your knowledge on saving for retirement, which is absolutely integral for everyone. I'm going to end the show with a quote as well by George Foreman, a former pro boxer and entrepreneur. He says, "The question isn't at what age I want to retire, it's at what income." And that, of course, assumes importance in light of our special. Thanks, everyone, for watching.